And I just touched on it briefly there. Fed Chief Ben Bernanke will be back on Capitol Hill today, a day after he said the U.S. economy may fall into recession in the first half of the year. For more on this and what we can expect today, we are joined by Clive Hyman, CEO at Hyman Capital Services, and Kowalczyk, Chief Investment Strategist at CFC Seymour. I'll start with you, Clive. He basically acknowledged that a recession is either right here now or on the horizon. He said the word, and the market seemed to not collapse because of it. We stayed up pretty firm. What's your sense of how surprised you were at what Mr. Bernanke said and then the market reaction?
I think it's difficult when somebody's trying to push you into saying the R word in front of a camera to get you to confirm it. So I think I take comfort from the fact that it wasn't on his lips the whole way through the conversation. I do sense that the economy is slightly more robust than people might imagine, seeing some of the panic that's going on in the financial institutions. I think what's happened is that we've got overextension, and I think that we spotted that way back in September last year. So I think some of this is playing out as commentators have expected it would. I guess some of the real surprises have just been exactly how much is in the cupboard in some of the investment banks, and I'm hoping that we might, it's too early to call the bottom, but I do think we might be seeing some normalization coming back into the markets. The encouraging thing is that the stock markets are still holding up and there hasn't been panic. So I think one of the things that I'm picking up in the marketplace is investors are beginning to get a little bit of confidence back. Slight concern over the period has been, the herd mentality. And I think I heard on your program before, investor decoupling, there's equity decoupling. There's been quite a bit of that. I think the U.S. housing market is of particular concern, but again, what I'm seeing is I think.
Clive, I'm sorry to jump in, Clive. I want to bring Derek into the conversation. I didn't mean to interrupt you. Derek, what's your sense then when it comes to Mr. Bernanke? Is he hedging his bets and setting us up to expect the worst, and we can just be maybe a little bit surprised to the upside if it's not the worst?
I think he is definitely hedging the possible outcomes, because he said that there is a possibility of recession. It doesn't mean that he is predicting one. However, the market already knows that. In fact, the market would say it's highly probable that we are already in a recession. Because Bernanke didn't say anything that we don't already know, and in fact was maybe a little bit more optimistic that consensus calls for, the reaction was quite favorable to the usage of the R word.
And speaking of the R word, Derek, it's more here in Asia as well. The other R word, risk appetite. With how the Asia markets performed today, would you think that that is back on the table now?
Very clearly, risk aversion at least has declined. As far as appetite goes, I still think it's in short supply, but all the signs have been there for some decrease in aversion, and we saw gains in equity markets, we saw decline in the value of the yen, so clearly investors are not as scared of the future as they used to be. And again, I would credit Bernanke for that, because his comments to me were quite reassuring. He suggested that pretty much the Fed has done most of what they need to do, that they don't really plan anything major in the future, that there will not be another bearish turn. So it seems like it's kind of, setting us on the part of Bernanke for some more stability going forward, at least in the near term.
Meanwhile, Clive, we've got a big boost in commodity prices, and food prices particularly keep rising as well. We've got political intervention in parts of the world. Is that a story that's going to keep simmering, and how much of an issue is that?
Well, fundamentally, if your food prices keep increasing, then they're going to come through into the retail price index. I think we're going to see some inflation. I think above targets, but I think the main thing that we're going to have to watch for is that prices are going to rise. The interest rate cuts that are coming into the market don't seem to be getting translated into the consumer's pocket. So there's going to be increasing pressure in the wage market for increased wages, which is going to put cost pressure back into the market.
Derek, it's good news for those in that sector. Syngenta today, which is Swiss Agrochemical and Seeds Group, came out with a big rise in profits. Are you looking to invest still into this food story?
I think that food and agricultural commodities are the part of the agricultural area that is going to outperform during the rest of the year. Most of the other commodities, such as precious metals and energy, have been largely fueled by decline in the value of the US dollar and in financing costs. And I think that both of them are pretty much over by now. As far as food goes, the demand-supply equilibrium is clearly very bullish. So I would outweigh agricultural products among commodities for the remainder of 2008.
And Derek, in Asia today, we saw a big lift for the exporter stocks, especially in Japan, on the back of the weaker yen, which has come down to levels we haven't seen in about 3 or 4 weeks here. Do you expect to see the yen continuing this trend downwards for a while longer?
I think that in the near term, what we are going to get from the US, especially in terms of data such as payrolls tomorrow, is probably going to be better than expected. And if this is the case, the risk aversion will decline further, some more risk appetite will show up. This would be negative for the yen. So I would bet that the dollar-yen will continue creeping towards 105 over the next several days.
Thank you very much, gentlemen. Derek Kowalczyk and Clive Hyman. Derek is the Chief Investment Strategist at CFC Seymour in Hong Kong, and Clive is CEO of Hyman Capital Services Limited. Thank you very much for the insight on this Thursday.